Welcome back again. And we're going to go into insurance policies at this point. And as I said previously in the introduction to this from the previous module, is that it's different in terms of what kind of insurance policy you do when it comes to an investment property than it does with something that you're going to live in. So I want to go through this and try to make sure that you get the right policy, not the cheapest policy, but a policy that really covers you in case you have problems, and problems, as I said before, can occur. So first of all, choose a deductible. Now, I will tell you that just a simple rule of thumb, the least amount of claims that you can make, the better. If in a particular short period of time you make a lot of claims, then what's going to happen is you get put into a high risk pool and it's going to skyrocket. So there has to be a darn good reason for you to go ahead and make a claim. Normally, with what I deal with, a roof is number one. That's typically because of storms where you're going to have the most damage. But even in that situation, rather than make a claim, I have a roofer, a really good roofer, and we all have these, come out and say, hey, this is something you should or should not make a claim on. So you need to know that first and foremost. You don't want to make a little claim, but a major claim, something that might cost you $10,000 or $20,000, absolutely, you should make the claim. So what we're dealing with right now in the market that we're in is typically either a $1,500 or a $2,500 deductible. So, and I tell you what, I'll just give you a little hint about how property managers work when they're really good. Their roofers, for instance, using that again as an example, really know how to work with insurance companies. They may be able to minimize your out-of-pocket expense on something like that. So, don't go to a really low deductible because, it's not like the old days where a $100 deductible was cheap. They're very expensive. So consider going to $1,500, $2,500. If some people do $5,000 in that particular respect, depends on your financial situation, what you can afford, because obviously this is going to affect the price that you pay for insurance. And make sure that extra riders are not required. So, for instance, I'm in an area where there's tornadoes, all right? But tornadoes are covered. Matter of fact, even earthquakes are covered. So, that's not necessarily the case in California, as you know, or hurricanes in Florida. So some places may have the need for having addendums or extra cost put upon that. So, something, earthquakes, flood, hurricanes, these are the type of things that can really up your insurance quite a bit. Make sure you look to see not only the deductible, but everything that is covered or not covered in terms of what's in the process here of putting the right insurance together. Now, I think a good property manager, just to give you a little bit of extra here, a good property manager is going to require that the tenant has a tenant insurance policy on their own because it doesn't cover them. Now, also understand that condos are different in terms of their insurance than a home, a single family home. So a lot of times there's maybe a difference on a condos because there's common areas, there's certain things that the condos handle, but again, deal with your insurance policy on that, deal with your professional on that. Regardless, get the right deductible. All right, this is one that constantly is brought up, and I've been on national webinars and seminars that I've spoken, and I go, how in the heck did they get that insurance policy down so low? I know that that's lower than, possible, but it is possible. So a actual value, let's say you buy a house at $220,000. An actual value policy is going to limit a total loss to whatever that actual policy value is. Usually it can be $220 or it could be less. So in other words, if you get a total loss on actual value, you may have a lot of money out of pocket that you have to do. Replacement value, on the other hand, is something that if you buy a house at $220 and you put replacement value on it and it costs $250 to replace, remember a total loss, you got to do destruction work as well as construction work. It's more expensive. And so because of that reason, you want to make sure that replacement value is something that you're only out your deductible, not $20, $30, $40, $50,000, which you may not want to really invest or have. So I recommend replacement value every time. It's not that much more. And I always look at the worst case scenario, Now, I'll give you just a little hint too. Replacement value is not ultimate. In other words, if you're in an area where, things have gone up double, triple, or whatever, there's still going to be a cap on what replacement value can do. So at 220, you just need to ask your insurance professional, okay, I want replacement value. Give me an idea how the cap works. What's the ultimate? What's the maximum? And another thing, that may be another reason for you to sell the property in that particular respect because of that particular reason. So make sure you ask about that. So we recommend replacement value because things are getting more expensive all the time. Labor is more expensive. Materials are more expensive. All right. So you have to put these things into consideration. So basically make sure you do replacement value. That is my recommendation. You can do actual value, more risk involved. That's your choice to make. Now, liability insurance. And this is going to vary from state to state. So for instance, in my home state, I can do $1 million. And I like doing $1 million because basically people don't sue you for 10 grand, right? They're going to sue you. They want the maximum amount, make it negotiable. So it's $1 million. Now in Florida, it's a different situation. It may be $300,000, maybe the maximum. And if you go over that, it may be very, very expensive. So make sure you have liability. If somebody trips coming into your house, they can sue you, and you absolutely have to have liability. So if you're even buying cash, and you want to self-insure, that's okay. But I tell you what, I would always make sure I had at least a liability insurance policy because that can really affect you. The other thing is for those of you that are going to get to a lot of properties, let's say you buy 10 properties and you have $1 million, 10 times. You can look to buy a commercial property that's going to package all those homes together. You may want to say instead of 10 million now that I have, I'll do 3 million. I've never been sued, all right? Maybe I'm lucky, but the chances of you being sued over and over again are not great. So if you get up to a lot of properties, start looking for a commercial property insurance policy. Cut down on your liability. It's one thing that I think you should look for, but that's not where you are right now. If you get there, look for it. Now, this is really huge for me. It's another way that I think some people cut down on insurance to make their numbers look good. Loss of income. Let's say you have a fire and it takes 4 months. If you have a fire, you got to get the insurance company in there. You got to negotiate with the insurance company, and then you got to get permits, and then you got to get the thing done. So 4 to 6 months is not unusual if you have some serious problems, or a year if you have a total loss. So what loss of income is you've got a mortgage that regardless of whether it's empty or not, because of damage, you got to pay for. What loss of income does is give you money from the insurance company while that is unoccupied so you don't get into serious trouble. Now you can choose 6 months, you can use 12 months. So understand just what you want to do. A total loss is never going to be 6 months, by the way. So this is another thing that's different about investment property in terms of an owner-occupant property. This is something absolutely I believe in. I've seen it happen. I've seen people have fires. I've seen houses destroyed for various reasons. You got to start from scratch. You want to have the insurance company on the line to pay you. It's a little bit of money, but compared to what you would put out otherwise, it's really a good value. So make sure that you have loss of income. Those are the most important things to look for if you're an investor looking for an insurance policy to lower your risk, lower the possibility of putting out a lot of money. So we've done that. And the next thing we're going to go into contract to close is we're going to start establishing a timeline. So you can understand where you go from point A to point Z. So let's start with point A, which we already did with the contract. Let's go a little further into it, and let's talk about the timetable in the next class. Stay tuned.